Hello and welcome to this video on external sources of finance. So to recap, sources of finance are the options available to a business when seeking to raise funds to support its future actions. So for example, a startup business might be raising capital to help establish the business, whereas an established business might be funding growth or implementing a new strategy. In this video, we're going to look at what is meant by external sources of finance, be aware of 5 different external sources of finance, look at the difference between sources of finance and methods of finance, and finally be aware of the 7 methods of finance. Let's get started. So a business will typically have internal and external sources of finance, and in this video we're not focusing on internal, we're talking about external sources of finance, i.e. funds that come from outside of the business. Before we get started looking at the sources, let's distinguish between sources and methods of finance. Sources of finance is where the finance is coming from, i.e. the provider of the finance, whereas a method of finance is how the finance is provided. So for example, a bank, the provider, might use a loan, the method, or family and friends, the provider, might use share capital, the method. So a source of finance is where the money comes from, and a method of finance is how it is transferred or introduced into the business. Right, let's look at the sources of finance now. The first source might be quite familiar to you, which is family and friends, if you have any. And this involves investment from people known to the entrepreneur. And an advantage of this approach is that the repayment terms and conditions might be quite flexible. You can negotiate, and they're likely to be quite lenient perhaps on when you pay them back. A disadvantage, well, depending on your family and friends, it might be quite a limited amount available, and if your business ends up not doing too well, it may place pressure on that relationship. Source 2 is banks. Banks are financial institutions that are licensed to take deposits, pay interest, make loans, and provide related services. And for each of these sources and methods, you should take down the definition that is in bold. Banks will often have departments and employees who specialize in giving businesses finance, and they also provide advice on things like business planning. Our third source is quite an interesting one, which is peer-to-peer lending, and this takes place through a website. And what the business will do, the borrower is the business, will be assessed by the website on how creditworthy they seem, how well able they're likely to be able to pay back a loan, which is the credit check. And then once they are satisfied that they are a credit-worthy borrower, their loan will be placed on the website, at which point a number of investors can offer to provide the loan to that business. And they will offer the rate of interest that they are willing to give with that loan. The borrower can then select the investor who offers the lower rate of interest. So in this example, it will be the investor who offers 7% is most likely to be selected, and then that money will be transferred to the borrower and that loan will be taking place. So to summarize, peer-to-peer lending is the practice of an individual lending to other individuals, peers, with whom there is no relationship or contact. The lending takes place online through a peer-to-peer lending company. The borrowers are given a credit rating, and then the lenders decide who they want to lend to, and then there is a reverse auction. The lender that is willing to offer the lowest interest rate wins, and they lend the money to the business. The fourth one we're going to look at is business angels, which is a similar idea, but it involves just one individual who makes a personal investment into the startup business in return for a share of the business. So it's not a loan here, it is buying a percentage of the shares with their investment. So generally can be seen as high risk. It's not a loan, it's buying into the business, so it's related to future profits. And again, the entrepreneur will need to demonstrate a good understanding of their business and present a detailed business plan to the business angel in order to secure the investment. But once they're on board, kind of like Dragon's Den, they may also offer support and expertise. Okay, our last source is crowdfunding, and this involves getting finance from a crowd of people through to an individual entrepreneur or business who have set up. Here is a good example. Again, this takes place on the internet. This business here, this brewing company, have placed a summary of their business and some key information on this website, and they are trying to raise £500,000, and they are trying to raise that by selling 9.8% of their business. And what investors can do is come onto this website, and if they like the look of the investment, then they can buy any amount they like of the shares that are available. So far, if you have a look here, there are 216 people, investors already, who have bought shares, and they can buy any amount. And so far, they have bought £295,590, which is 59% of the target. There are 10 days left, and these investors' money will only be taken if within those 10 days the full target is met by people on the website. So to summarize, crowdfunding involves raising finance from a large number of people, each investing different, often small amounts of money. The business uses the internet to explain how much money is required, how it will be used, and how the investors will get their money back, which is known as the exit strategy. The investor is only tied to their promised contribution if the total amount is raised in the time frame. Source 6 is other businesses. And businesses with lots of healthy cash balances or lots of cash may look to invest in other businesses. And they're probably trying to do that to generate a higher return on their cash than they would if they just had it in a bank account. So for example, businesses such as Apple and Google have recently invested money in wind farms because they believe the return they would get on their money, the dividend and the increase in the value of what they own, will be higher than what they could get if they just kept all their millions and billions in the bank. So we've looked at our different external sources of finance. Now let's move on to the methods of finance. Again, we should focus on taking down the bold definitions. So method 1 is a loan, and that is a set amount of money provided for a specific purpose, normally, to be repaid with interest over a set period of time. Often this is secured against an asset, and if there is a default on repayments, the asset can be taken. So normally the business might nominate a bit of machinery perhaps, and if they don't pay the bank back, then the bank can force the sale of that bit of machinery to get the money back from the loan. The interest rate normally varies upon the level of risk, and the riskier you are considered to be, normally the higher the rate of interest you're asked to pay. Generally speaking, it's considered more suitable for longer term projects as loans tend to be over a longer period of time. Some advantages and disadvantages. A fixed interest rate allows firms to budget carefully. If you take out a loan, it doesn't mean you lose any of the ownership of the company. However, on the flip side, you have to pay back interest regardless of how well your business is doing, which is different to a share-based option. Okay, method 2 is that one, the share capital. Shared capital is finance raised from selling shares within the business, which is often known as equity. If you have an equity stake in the business, it means that you have shares in the business. So for example, the shareholders become part of the owners. On this chart here on the top right, we have 4 shareholders, 1, 2, 3, 4, and they've all invested £25 for one share. So the business has 4 shares, and that is worth in total £100. Now, there are normally more than 4 shareholders when a business issues share capital. There normally might be lots of individual investors, or perhaps other banks or institutions might invest as well. Shareholders are rewarded for their investment by getting paid some of the profits, and that's called dividends. But also, if the business does well and becomes more valuable, then the value of the shares that they own, the share price, might increase as well. This is only an option for incorporated businesses, so limited businesses and PLCs. And issuing shares is normally quite complex and costly, lots of different people buying shares, so it's really only an option for raising large amounts of finance, normally used to fund long-term projects. Some advantages and disadvantages. Well, you only need to pay back your investors if a profit is being made, and the amount of the dividend is generally not fixed, unlike a loan option would be. A disadvantage, well, you do lose some of the ownership. All the shareholders become joint owners, so there is a loss of ownership to the business or entrepreneur using this approach. Okay, method 3 is venture capital, and that involves an investment from an established business into another business in return for a percentage equity in the business. Also sometimes known as private equity finance. So when one business invests a large amount or buys ownership in another business. Normally they're looking for a high rate of return over a specific time period. They don't, generally speaking, want to own the business forever. But they will provide expertise and mentoring to make sure that the business they've invested into is successful. So it's often associated with high-risk startup businesses. Again, some advantages and disadvantages. Well, an advantage here is the expertise perhaps that you get from the venture capitalist. A disadvantage, again, you lose some ownership, and often it's quite a long and complex process. Okay, method 4 is an overdraft. An overdraft is the facility to overspend on a current account up to an agreed sum. So it's provided by a bank, and over here it looks like this business is overspent by £437.31. So if they had an overdraft for £1,000, then the business would be allowing them to overspend up to £1,000. So here they're £437 overspent in their account. So the business in effect can withdraw or spend money from the account that is not there, meaning they go overdrawn. And interest is charged on the amount that they're overdrawn, not the total limit. So it's a good short-term source of finance, useful for day-to-day cash flow issues. And it's normally provided by banks or building societies. Some advantages: where you only borrow when you actually need the money. Quick and easy to arrange, generally speaking, with most banks. However, on the flip side, it's normally only your interest is normally variable, making it more difficult to budget because it depends how much into your overdraft you go. Okay, number 5 is leasing. And leasing allows a business to benefit from the use of an asset without owning it or buying it outright. So the business pays a set amount in installments to lease the asset, which is equivalent to renting it for a predetermined period of time. So for example, if a business decided they wanted a fleet of vans, they might consider, well, do we actually need the money to buy the vans outright, or should we just go to a business that owns the vans and then just rent them off them, have a lease, which would normally involve signing a lease agreement with the company, so the property remains part of the leasing company, and at the end of the time period, the end of the agreement, the vans here would be returned to that company. So it avoids the need to generate large amounts of finance to buy the asset, but in the long run it could be more costly because you need to pay the lease payments and then you don't get the asset to keep at the end. Often at the end of a lease, the business will swap up for the latest module. Okay, method 6 is trade credit, and trade credit is paying suppliers a period of time after the goods or services have been received. So if you think about it, in effect, the supplier here is providing the business with a form of finance for the period of the trade credit. So if the business takes the products but hasn't paid, it's kind of like they've been lent the money by the supplier and then have agreed to repay them that debt at a later date. So we do consider it a form of finance. Any negatives to this: the business may lose out on discounts. You might often get a discount if you pay immediately, whereas if you use trade credit, you might not be entitled to that discount and have to pay more in the long term. Method 7 is grants, and grants are fixed amounts of capital provided to the business by the government or perhaps other organisations like the EU to fund specific projects. Often conditions are attached to the grants, so they have to, maybe the business has to locate in an area of high deprivation to provide employment, or maybe they have to reduce any negative environmental impacts of what they're doing. For example, businesses in the UK have recently been entitled to grants that helps or they install Wi-Fi in their premises. Okay, so in this video we've looked at the 5 different sources of finance and the 7 different methods of finance, distinguishing between the two. That's it.